Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockbourne. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. I'm joined today by Tom Davies, co-founder of Bloom Developments. Tom set the business up in 2020 with his co-founder Sam and got a commitment from Angelo Gordon to build a portfolio of ultra-urban warehousing in central London. So welcome to the show, Tom.
Thanks very much, Matt. Great to be here with you.
Not at all. Well, look, good place to kind of start with all these things. I'm always fascinated about how you got into property and why you wanted to pursue a career in the space.
Sure. I mean, it's funny really because I kind of fell into property by chance. So a lot of people I'd kind of spoken to in the industry had a family member or knew someone quite closely that kind of worked in the property sector. And as a result, knew about it. I didn't have a family member. I didn't really know about the industry at all. I'd never even really targeted working in the sector to judge if it'd be suitable or had any work experience. So I was leaving Manchester University, having done a business studies degree, and initially I thought I wanted to work in finance, private equity. But when I got to the end of my degree, I wasn't hugely inspired about these industries and was at a bit of a whim, really. I didn't really know what I wanted to do. What I did know, though, was that there were two things that were important for me in whatever that next job was. So one was to work in an exciting industry, which was on the rise. And the second was to work at a corporate business where I'd be exposed to how business is actually run, with exposure to all the different departments and functions and strategies, tax, finance, marketing, legal, because this would help me in my ultimate goal, which was to found my own company.
So that was like the ultimate idea at some stage. It's just quite far off. What I find quite, not rare, but what I quite like and is interesting about your background is you worked at a lot of places, like interned, got experience. And I know other people have, and maybe they just don't put it on their LinkedIn, but it looks like you, in lots of different sectors, you got a lot of different experience. And do you find that really useful in terms of fine-tuning what you liked, what you were good at, but also what you really didn't like as well?
Yeah, no, definitely. Probably should take that all off LinkedIn because it's basically got my whole life story. Yeah, I mean, my dad was a corporate guy and basically had worked at a number of companies and was quite a senior manager basically, and was CEO of a few companies, and he was always pressing me as well as I was driven to go and find out through work experience exactly what I liked and what I didn't. So to be honest, it was every summer we'd just try and look through his kind of contact list and see out of who he knew, I could go and work with for a bit. So I did some work at IMG, who was a sports management company. I did some work at Boodles, who are a kind of high-end jewelry company where I actually focused on logistics at the time, which was quite interesting. And then when I left school, I did 6 months working at a builder's merchant in New Malden and Kingston. And my first day being asked to go and get the bacon butties with white sauce, and I said, what was white sauce? And got laughed at.
The old classic.
Shows about my sheltered upbringing. But it was really interesting because it kind of gave me perspective of the different types of opportunity out there, which as I said, from my background, I didn't really understand or know what property was, but I did some other sectors. So it gave me an understanding when I was thinking about the types of property and the types of occupiers in that space. Builders merchants, for example, they have sites all over London.
Yeah, we
would love to own. So I get how they work, I get how they operate. And it's given us a great insight with Bloom to be able to go and approach those guys and have conversations in their language effectively.
So kind of property was you became aware that property was a career or a route to go down. Having done a business degree, what was your mindset then? Did you do the masters, get the real estate experience, or was it try and do non-cog route at a big surveying firm?
So when I left Manchester, basically one of my best friends said to me that he was applying to do a master's degree at Reading in real estate. And I thought it sounded quite interesting. So I just applied and surprisingly got in. And at that point, I was like, well, I haven't got anything else to do. Sounds interesting. Started looking into the industry more and more and started to get super excited about it. So I went and did it. So I turned up to Reading with basically no real estate experience at all. And to be honest, I lacked experience and knowledge. And that became very clear when I started going to interview with CBRE and Savills and Knight Frank. And to be honest, I got laughed out of the room on a number of occasions. I then started to research heavily into the industrial and logistics sector, which I became really passionate about. And it was on the rise at the time. I became obsessed with it. And that really showed when I applied to SEGRO. And I presume, that along with the fact that I had quite an entrepreneurial mindset, I think they quite liked and they took me on.
So that was your experience of a few failures and setbacks at the larger surveying firms, and then probably waking up a little bit and smelling the coffee and doubling down on what you're really interested in.
I think for me, it was, as I said earlier, it was always trying to find a sector that I thought was on the rise. And I could have gone to one of the property agencies and worked at a CBRE doing investment advisory or doing development-led advisory. But my view specifically with my end goal of creating a company myself was that I wanted to understand how a business worked. And no disrespect to any of those companies, but, in my experience, you might not be getting quite the exposure to the different areas of a business like you would do at a corporate and a FTSE 100 business, which I was working at. So for me, it was very important to go client side from day dot, given I knew that at some point I was hopefully going to be building a similar company myself.
And as part of landing at SEGRO, was it a rotational program? Were you kind of just like dumped straight into the investment team, asset management team? Were you based in London or was it Slough? Because I know that they had it was main Slough office at the time, wasn't it? And a satellite office in Central.
Yeah, everyone at SEGRO calls the Slough office Slough Bados. It's not quite as glamorous working on industrial estate in Slough, but it was very informative for me. I had an amazing time working there and I genuinely couldn't recommend it highly enough. And I think also, from doing kind of my own thing now, I've really used my learnings and relationships that I've made at SEGRO to find opportunities, drive strategy and make decisions for our business at Bloom. I often get laughed at in the office for mentioning SEGRO all the time, but it was formative years where I basically had my real estate education. But when I got there, I started as a graduate, was there for just shy of 5 years. I started in the Greater London investment team, did 9 months. Was exposed to various transactions and disposals, acquisitions and joint venture buyouts, which was amazing. And I wouldn't have got that experience in many other places, I don't think. I then worked in the Thames Valley asset management team, which was on the Slough trading estate. I was based there, living in Brixton, an hour and a half each way commute at least a day, which was always fun. But again, there I learned what I think is a very undervalued skill, and I'm by no means an expert in it, but I really learned about the landlord and tenant relationship and the importance of that and the importance of the lease has on driving or killing property value. And then I moved into the Greater London development team where I worked for circa 3.5 years, and I was focused there on basically trying to find opportunities in the inner M25, as well as take existing sites that SEGRO owned and redevelop and reposition them into brand new high quality kind of mid-box or multi-let industrial and logistics estates.
And were you part of a small lean team there where you got lots of exposure, or were you just kind of a cog in a slightly larger institutional beast?
I think the thing that SEGRO do really well is that they do give you accountability and responsibility quite early on. And, even as a grad, I was managing a couple of development schemes, having been working for 18 months, and personally find development, even though I do it day to day and I've done it for quite a while now, it's still very complex and technical, and it does take time. It's basically just time spent. You just need to spend time doing it and you'll get good at it. But I definitely wasn't equipped to be doing it at the time. I did have a great kind of mentor who was the development director at SEGRO, who was overseeing my development as well as giving me the support I needed alongside my line manager. So I got thrown in the deep end, and I think, I used to have to go into planning meetings, as a graduate having just qualified, and kind of lead meetings with local authorities, from the very outset, or lead meetings with landowners, who has got 20, 30 years of work experience under their, on the books, and I've got 2 at this point. So there were some good learnings, but getting thrown in the deep end meant I could learn at a real fast pace.
And it's quite a big call after nearly 5 years, clearly doing well, enjoying it, to leave and go and join Antler, which I don't know too many people probably within the real estate space who'd have heard of Antler. I've got a few friends who've done it, but maybe from banking or kind of the tech space industry-wise. But what is Antler, and why did you leave SEGRO and wanted to go and pursue that?
Sure. So I'll start with the SEGRO kind of point. Firstly, as I said earlier, I've got nothing but good words to say about SEGRO. I did always have the drive to found my own business, which is why I left, but I could have happily short stayed there in another life and done well, with the great people that work there. But when I was at SEGRO, in the background, I was spending a fair amount of time exploring different business ideas, mostly centered around real estate or prop tech. And to be honest, I was spending actually quite a lot of my weekends just like trying to create decks for ideas, trying to go and meet people and arrange coffees and just trying to get stuff off the ground. And I probably had about 4 or 5 ideas that I looked at that I killed, some of which lasted 3 months, some of which lasted a year. But
property related or?
yeah, quite a few property related. And I'll come on to kind of the one that I basically took with me to Antler. But yeah, I mean, as geeky as it sounds, I'm obsessed with warehousing, logistics, prop tech, e-commerce, last mile delivery. You know, they might not necessarily be the most sexy industries, but, you know, I think the trends are really exciting and for the most part, they're at their infancy stage with a lot of potential for innovation to come. When I was, just before I left Seagull, I was developing a business model not dissimilar to Gorillas and Getir and Go Puff. And this is about 3 or 4 years ago when I kind of felt that quick delivery was coming into the UK. It was already in Asia. It was in the US.
Yeah.
It was coming. And basically I had a pitch deck that I've been working on for probably about 9 months to a year. Business model, financial model, started chatting to VCs before I left Seagull, and then probably rather naively thought I could build the company. So I thought I'd be best suited to do that on a startup generator, which Antler is. And Antler basically, it's quite an unusual process, but they take 70 people from different industries, either commercial or tech people, and they put you in a room for 2 months. And they just basically try and encourage you to think of ideas, always problem first, think about the problem, and then try and validate it, whilst also trying to find a co-founder that you have complementary skills with. So yeah, I spent basically 2 weeks in person doing the AMP program, and then COVID hit. And then I was trying to find a co-founder for 5, 10, 15-year business, however, maybe life over Zoom, which was pretty tricky. But the idea around the last mile delivery company I had, I pitched to Antler, and they're worried about the amount of follow-on investment that would be required. And to be honest, they were bang on. I mean, Gorillas and Getir, these guys have raised a lot of money.
Burnt through billions.
And I didn't have a background in, in logistics, so it would have probably been hard for me. But I was advised to Antler to look at other ideas, and I started building a property data analytics company instead. And I secured some good pilots with some quite interesting companies and kind of household names for what we were doing, but I just wasn't passionate about it. So yeah, that led us on to kind of the idea for Bloom.
So how did you come to meet your co-founder and set Bloom up?
It's not the most exciting story and definitely lacks romance, but Sam and I actually met when we were about 16 through mutual friends. And we used to go to school to similar schools near Oxford, but we actually became good friends at Reading, where we were doing our masters together. And at the time, we didn't know it, but I guess our great friendship is the best thing that has happened, for both of us from Reading. It's probably worth me setting the context of kind of what we do in terms of our business model and the market we operate in. For those that, aren't necessarily as close to real estate and property, the majority of industrial and logistics property is located on the edge of towns in specific industrial style locations. And you'll see these as you drive down the M4 or you drive on the M25 on the North Cirque. But more recently, due to the advent of technology, digitalization and e-commerce, the industrial and logistics sector in London has been absolutely booming for probably the last 5 to 10 years, as these trends have really driven the demand for industrial space from occupiers. However, these trends have also started to impact consumer preferences, and many consumers are now demanding convenience, and they're starting to consume goods and services instantly. And this has meant that an increased demand for the non-traditional inner city warehousing, which is what we focus on today, has started to really take hold. So what we do is we're targeting building a portfolio of industrial logistics sites in non-traditional locations, being the city centre. So being like zone 1, zone 2.
Yep.
And we've got a portfolio now with 6 assets located in Hackney, Greenwich, Fulham, Brixton, Camberwell, which are all very central zone 2 locations. And we've also got an asset in Park Royal, which is one of those more traditional locations. But we're doing that because we see these trends at their infancy stage, and we think there are going to be more and more businesses who are driven to take space in more central areas in London, where, to be honest, the vast majority of that space is being lost to high value uses like residential.
Yeah.
So in London, in the last kind of circa 10 years, each year there's been 100 hectares of industrial land lost in Greater London, just at the advent of all these technological changes and trends that have increased the demand for space, which is why there's been a real boom in the sector and weight of capital coming into the sector. But in terms of how we kind of came around setting up Bloom, so when I was at Seagrow, they'd started exploring investing in this in these more central markets, non-traditional kind of industrial logistics market, if you want to call it, normally where offices and retail and residential are located, which is actually the attraction for putting industrial estates there, is that you're next to the end consumer, basically. You can deliver goods and services super quickly. When I was at Seago, we started exploring, or they started exploring these trends, investing in more central locations. But generally at the time, and this was 2.5, 3 years ago, it was more focused around big sites and looking to try and build new sites for the post and parcel and urban logistics sector, being the DHLs, the DPDs, the Ocados and the Amazons. I'd always had a suspicion that there was in fact a wider and more diverse customer pool for who want sites in these types of locations.
So occupier is what you mean by customer.
So our occupiers are our customers, effectively, yeah. So I thought there was a wider kind of diverse pool of potential sectors and occupiers that might be interested in taking or letting, effectively, ultra-urban warehousing, as we call it. So I basically pitched this idea to Sam, having completely ignored quite a lot of the lessons I'd learned on Antler around being, really forensic with how you select a co-founder. I've known Sam for so long, it felt right, and we just gave it a go.
And so in terms of your customers, the occupiers, anything from trade counter occupiers to dark kitchens, last mile logistics, SME types, are these all of your customer profiles? And ultra urban, these are the people you're going after?
Yeah, sure. So, the word ultra urban for us means basically kind of anywhere inside the North Circular and now South Circular, basically. So warehousing in kind of central inner city locations. And when we started out, Sam and I, we had an inclination that there were a number of occupiers and sectors that might want to have warehouses located in those more central London markets, but we wanted to go and prove it. So we spent the first 6 months speaking to around 100 occupiers across various sectors to understand, did they actually want to be located in these central locations? And if they did, what does the space need to look like? How does it need to be designed and how does it need to operate? So we basically went and spoke to a range of customers or occupiers across the traditional and modern, what you might call more modern business models, but across those two areas. So that was on what you might call the more traditional side, self-storage, post and parcel, manufacturing, retail, food and beverage. And on the more kind of modern side, i.e. newer business model that spawned out the trends I mentioned earlier, like dark kitchens, on-demand grocers, e-mobility, urban farming, and there are loads more I could mention, but those are kind of our core customer set that we want to occupy our warehouses.
In terms of selecting locations, what role does data have in steering your investment criteria?
So we want to be extremely data-led as a business. At the same time, we are a small business with limited resource. So we completely see a future for us where we've got data trying to feed in as it can into every kind of process that we can get it into to help inform our decisions. At the moment, the kind of data that we're using outside of what you might call more traditional property data, which is comparable evidence, looking at rental growth stats, looking at macro trends, etc., to drive decisions. We also use demographics data and location data to help us identify locations we think are going to be very suitable. We also use Dacha to look at supply and demand in certain markets. So, for example, in Fulham, a big driver for why we bought our site in Fulham was that they accounted for 49% of the total industrial and logistics supply in Fulham. So our view there was we're trying to buy sites in the most supply-constrained locations, which in the markets we're operating in, very central London, Zone 1 and Zone 2, where not much of this exists. It's quite often the case, but in certain instances, like with Fulham, it was even more kind of magnified, and it was a big driver for why we bought that site. In terms of other products we're using to or prop tech that we're using to try and help drive our decision making, we use CoStar at times, or have done in the past, but the main products we use are Land Insight and Nimbus. Because we're generally focused on trying to find development land and some investment deals, but development land particularly. It's got really good information on the planning background of the site, as well as just puts a lot of the key information you need to assess a site quickly in one place. And two of the sites that we bought today have come directly from using those sites, identifying suitable sites, and then going and meeting a vendor to go and discuss potential pricing for their asset.
So you've kind of got the strategy, got the idea, got the co-founder. How do you go about raising the capital to put all of this together?
Yeah, it wasn't easy. And particularly because, as you kind of noted earlier, Sam and I started Bloom in June 2020. So right in the heart of kind of lockdown and COVID. So yeah, we weren't able to go for coffees. We weren't able to come in and pitch kind of what we were doing. It was tricky to an extent, but at the same time, we kind of used it as an advantage in a way, because what we found was that a lot of the people we were wanting to speak to had a bit more time on their hands because they're working from home and they weren't traveling to and from work, and it wasn't always the case, but quite often was. So that, combined with the fact that we'd spent, Sam and I, a lot of time networking, and we also had a very good advisory board for our business, meant that we were able to arrange a lot of Zoom calls and quite quickly get a load of that in and get a load of validation in for our business model, but also start the conversations with funders and get agents, out the market with our requirement looking for sites. So it was a tricky time, and we effectively hosted a Zoom roadshow to try and raise funding. But interestingly, Angelo Gordon funding didn't come from that Zoom roadshow in a way. We actually made a real conscious effort to go and speak to anyone and everyone about Bloom, to get our name out there. Because we thought at the time that, whilst we're a real estate business and working in the property sector, we had quite a few connections in tech, and I'd done Andler and Sam had been in the US, and we're both very social outside of work. You never know where a crucial or helpful introduction or opportunity is going to come from. It might come from right in front of you, but it might come from, your granny or someone. You never know. So we basically went and spoke to all of our mates in any industry, and I started speaking to Fifth Wall again, who I'd worked with at Seagra, and Fifth Wall are the largest prop tech venture capital fund globally. I called basically one of their partners, Miguel Navora, who coincidentally at the time was about to invest in Gorillas. So Fifth Wall were about to invest in Gorillas, and we were talking about our experience, because Gorillas are mainly focused in the more central markets in the cities. And it was basically came to the market exactly the time when we were doing what we were doing, almost helping validate our business model in a way, which was helpful. But they were investing in Gorillas at the time, and we kind of gave our on-the-ground kind of view on how they're performing from a real estate perspective. And Miguel kindly invited us in to present to all of Fifth Wall's investors and their funds. So we were then, having tried to find any warm introduction we could to any potential investor or funder, put basically on a Zoom call in front of 70 potential investors in one go. And that was transformative, because it just so happened that the CEO of Angelo Gordon and the head of Europe Real Estate were on that call and called us after. And then we basically, took the conversation from there. We did have another term sheet that we're about to sign at the point, and we kind of spoke with AG quite openly about it, and they thought they could offer better terms, and they ended up doing so.
Co-founder in place. The advisory board's an interesting one. How did you put that together?
Sam and I were 28 when we started Bloom. To be honest, I'd run a kind of events business and have done for nearly 10 years on the side, but nothing like running a kind of tech company or a proper business, with, proper functions and teams and organization charts, and with, backing as well. So we're very inexperienced at this point, and we were knocking on doors asking investors to part ways with a lot of money, which is never easy as it is, but having had no experience on our own and track record effectively on our own of delivering what we were saying we could deliver, albeit we've done it for other people and funds, we've not done it on our own. We thought we really need to get a strong advisory board. We basically went about trying to find someone who was very sector specific in terms of the investment market, so to advise on stuff we were looking to buy, and the market give us kind of trends and kind of information and be collaborative on that front. We found a guy that I'd kind of met before called Rob Fowler, who was the ex-head of the micro hub strategy at DPD. So he was one of our potential customers and occupiers. So he's been incredible at giving us, a load of insight into how these operators work, what the buildings need to be designed like, etc. And then we've got a kind of seasoned operating partner and fund manager who's listed companies before, real estate companies specifically, who has been integral in advising us, on how to launch a business, what type of opportunities to focus on, how to negotiate the joint venture, etc. So that gave us a lot of credibility before we had the track record of actually delivering product, which we're still working on. We don't have that track record yet.
Yeah. From an economics perspective, so you've got a line to build £250 million portfolio with Angelo Gordon. From a typical GP LP structure, they often require, co-invest. I know you guys are pretty well connected, but beg, borrowing, stealing, 5% equity to make sure that, there's alignment in terms of the deal. How do you go about navigating when you're starting up giving confidence to your principal LP that there's alignment of interest when you're looking at these deals?
It's a very important point, and one that every funding partner we've probably spoken to has been very hot on, in the respect that they want to see that their operating partners, i.e. the guys that are on the ground finding the opportunities and actually delivering the opportunities, getting planning, building the buildings, letting the buildings, managing the buildings. That's what we do. That's our responsibility. But they want to know that you're doing that on the basis you've got skin in the game. And that skin in the game needs to hurt if you lose it. It needs to be hurt money. So Sam and I are 28, as I said earlier. We've not got much money. We've got some life savings, but what we do have is just energy and drive. And that was really integral for the likes of Angelo Gordon, in terms of just knowing we were going to work on this super hard. In terms of getting alignment into the deals, we do co-invest into the joint venture. A lot of the co-investment, to be honest, is from rolled up fees that we generate from the joint venture. So it means that the initial cash outlay isn't massive. There is some initial cash outlay, but that does mean that, we basically got the equivalent of most of our life savings in the joint venture.
Tied up in it. Yeah.
So it better go well.
Makes complete sense. So the business has grown in the last couple of years. You're a team of 7. How has it been trying to assemble a high-performing team with managing a capital and partner who's no doubt pretty hands-on, sourcing stock? How's that been from a recruitment perspective?
Yeah, well, firstly, I should say that, one of the main attractions from for working with Angelo Gordon was that they've had, I think, around 500 different operating partners. So they've been through this process so many times of taking, guys that have just left their jobs and basically helping them create a business that will then effectively manage their money. So Angelo Gordon have been integral in that. We have talked to them about, we've got our ideas on how we want to structure a team, and they've been very supportive of that. But knowing how their other operating partners have worked and speaking to some of their other operating partners has really helped guide us into kind of what our team structure and organisation chart needs to look like. We started out, Sam and I, in a kitchen. We were still in the kitchen probably 18 months ago during COVID, and we're now a team of 7 people. Recruitment has not been easy. It's not been easy for a number of reasons. Finding people that are genuinely motivated to leave their job, as we found, has been tricky. We've used our networks to try and tap people up and kind of explain to them the opportunity of coming to join us, but often they haven't been quite willing to leave their jobs at that time. And to be honest, our sector has been so competitive with the amount of investment capital that's come into it that it's been really hard to actually hire really good people for a lot of businesses, and it's been very expensive. And we're a resource-strapped business at, still at this stage, but at 6-9 months ago, even more so. So we've had to be quite cute and clever with how we try to bring people in. And we've got a team structure now that, we've got a couple of grads who we had as interns. They worked with us for 3 months, thought they were really good. Got an investment kind of executive who helps us find deals and bring them over the line. We've got a part-time financial director. Recently, we hired a development director as our first kind of real senior hire. He's got real track record himself. Used to work at Ocado, who are one of our target occupiers and customers, and then used to work at Capital Industrial, who are probably the best known multi-let industrial estate owner. So he's got really relevant experience and just gives us, a different perspective on certain decisions, on a certain way of operating. He's kind of already coming up with ideas that are improving things and making things more efficient, but he's also an extremely trusted pair of hands, and it means that Sam and I can go out and also try and focus on the next value creation opportunity, driving revenue, rather than focusing as much on, delivering projects day in, day out.
Yeah, you mentioned there's been a lot of capital that's been raised and a lot of money that's chasing the space. You mentioned obviously Capital Industrial. You've got your old shop, Segro, Patrizia, London Metric, Prologis, Valor, Mirastar, Marway. Like the list goes on. And you've also paid some pretty sharp prices. A couple of 2%ers setting the record, I think, earlier this year. How difficult has it been to source stock and compete with maybe some more established players?
Yeah, well, firstly, I find the concept of competitors in any industry can, for me, be a little divisive. It's true that we're often looking at acquiring or bidding on similar assets to a Valor or a Segro or a Capital Industrial or an Iron Properties. I mean, the list really could go on. And we're also trying to let our buildings that might be in a similar location to similar types of occupiers. Where an occupier has a requirement, they only need one building. They either choose ours or they choose someone else's. There is definitely, more interest from other parties that does have an impact on you. But I feel, given the market that we operate in and the vast undersupply of availability of industrial assets in London at the moment, there are enough opportunities to go around for everyone. We actually see our industry as being more collaborative than competitive. We see others like a Valor or a Segro or Capital Industrial who might be looking to execute similar strategies more as allies, who have a shared vision, importantly, to improve and develop the asset class and seek to have a positive influence through improving our industry's impact on the environment, sustainability and well-being, which is a real core driver of our business. So whilst there definitely have been sites that we bid on that others have bid on and won, there are also sites we've bid on and won. And, everyone has a certain amount of capital. And it seems to me, from our perspective, like we've managed to deploy ours basically pretty well and efficiently. But a big part of that is by trying to find off-market sites and not enter processes, where there's 10, 15 potential parties interested who are A, going to drive up the value, but B, some of which have quite significantly lower hurdle rates and return requirements than we do, which means we can't be competitive on some sites.
Yeah. Just a point on your existing portfolio. So you've got 6 assets under management. So Camberwell, Brixton, Hackney, Fulham, Park Royal. You're going to have to help me out with the 6th one. And Greenwich.
Roll off the tongue.
Talk to me about those assets. Yeah, are they multi-story? Are they E-configured? Are they T-configured? I know there's lots of, occupiers or customers are demanding particular configurations. Are they built to suit? Have you got doing spec builds on them? Talk to me about your portfolio at the moment.
Sure. So, we own at the moment with Angelo Gordon 6 assets in those locations that Matt mentioned earlier. And they're a mixture of investment deals and ground-up redevelopment deals and refurbishment or extensive refurbishment deals. So Camberwell, Brixton, Greenwich and Hackney are full ground-up redevelopment deals. So we bought older, underutilised industrial sites in all these instances where they are not fit for purpose for the modern occupier and where trends are going. And they're also not providing enough space on their plots, i.e. they're not providing enough jobs, they're not providing enough square footage or site area to be able to let to occupiers that are underutilised effectively. So what we're trying to do with those sites is intensify them as much as we can in the markets that they're in, ensuring they're suitable. So for example, Camberwell, Brixton and Fulham are all what we're kind of terming Gen 1 multi-story. So they are multi-let industrial estates, but which have ground floor space and first floor space. Yeah. So traditionally, industrial buildings have had first floor office space. We're putting in first floor office space, but we're also putting in first floor warehouse space. And that space will be accessed by a tenant who's also in the ground floor space via a goods lift, which will have kind of a 1.5 or a 2 ton loading capacity. And this hasn't been done in the UK yet. So we are operating in the new non-traditional market. We're calling the ultra-urban market. And we're also building buildings that have not been designed like this in the UK. So we're effectively operating in a new market with new design on our buildings. And it's not to say we're the only ones doing that, because there are others doing it, but that does mean, there are challenges, and, we've basically got quite a bespoke product that we're building on those sites. On our Greenwich site, we don't think that location is quite as suited to multi-story. There's not quite as much demand, and therefore we're delivering more of a generic style industrial building. And on our Park Royal site, this was an investment deal that we bought where it's already got tenants. We are looking to basically help these tenants grow within our estate and our portfolio and basically grow the value of that building through adding ESG credentials and initiatives, which I should just say we're doing across every single estate or building we own. We want to be leading the way in terms of sustainability in our market.
Amazing. A lot of challenges and a lot of hurdles that you've overcome. What would you say the biggest challenge has been in your short 2.5 year existence?
I think in terms of ongoing challenges for a business, we've got the usual stuff so from a business and operational perspective, there's the usual areas around hiring top talent, being a newish business, which I didn't actually touch on earlier, but trying to tell someone, about the potential of your business and convince them to come and join you as a new business is quite hard. Looking at managing cash flow versus the opportunity cost of not investing more into your business and getting the return on investment is always tricky. And I think also kind of balancing the ability to be commercial and do all the commercial stuff that comes with founding and running a business, like HR, tech, accounts, marketing and legal, with Sam and I actually being property guys and needing to be a development manager at the same time and manage a project and manage a team, as well as manage the acquisitions, bring them in, find new opportunities. Doing all of it means you're basically doing the ops and the management and the strategy and everything in between. And that, luckily there's two of us, which is helpful, but that is tricky.
How do you divide that between the two of you?
Yeah, I think it's an interesting question because, as I said, when I was an Antler, it was very focused around finding someone with pretty complementary skills, different skills. So if you were the CEO or the CTO, and Sam and I are ultimately both commercial people. I've got more experience in some areas than him. He's got more experience elsewhere. We've got slightly different characters. But, we're both, personable and we also like meeting people and finding opportunities and doing deals. So we kind of, we split some of the areas in the business where one of us leads, the other one's still involved, and it seems to work quite well at the moment. But there's this old adage of being a resource-strapped young business, both kind of still doing a bit of everything, and it probably, not being quite as streamlined as it could be. And that's unfortunately the nature of the beast when you've got so many different things going on. But it's certainly, something that we're conscious of and how we set up the organizational structure moving forward. And when we get to the point where we're able to keep hiring and, do more of that, then, I'm sure it will continue to evolve.
Delegate to elevate. What's your read on the market at the moment, given the economic state, inflation, interest rates, noise generally? What's your view?
Well, it depends when this podcast is going to be released, to be honest, because everything's changing almost on a daily basis at the moment. Not quite that quick, but it's changing rapidly. I suppose for the last 4 to 5 months, the market's been in a pretty weird place. And when I say the market, I mean the industrial logistics market, property market in the UK. So for those that aren't working in property, just people trading in and out of owning real estate, being in the industrial logistics sector. So following Russia's, devastating invasion of Ukraine, the impact of various other areas, including rising interest rates, inflation, cost of debt swap rates, and consumer spending confidence, there has been some real uncertainty. It feels to us and what we're hearing in the market that the vast majority of investors in our sector, of which there was a huge amount of wealth, an amount of capital coming into the market at record numbers until 4 or 5 months ago. But the majority of players in the market have turned the tap off over kind of the last 4 to 5 months and have stopped deploying their capital due to the economic uncertainty. And ultimately trying to understand the impact on property values, which isn't clear at the moment. Rather than diving in now and potentially paying too much for an asset, the majority of investors seem to want to see where the market pricing and discovery or exploration lands. It's difficult at the moment. We don't know where the market yield effectively is for property, and therefore it's quite difficult to value opportunities. However, we're still very convicted and looking to find opportunities and buy now. We think that the fundamentals underpinning our sector, our long-term trends, are very strong. There's very low vacancy. The occupational market seems to be performing well. And this is driving the rental growth, basically, that's creating that capital value, albeit yields a little bit of an uncertainty. So we purchased our asset in Camberwell in May. We purchased our asset in Park Royal in June. During this period, we're still, looking for opportunities, and it's important for us that if we are going to find an opportunity, we've got to have, a willing vendor who's willing to sell right now and will be committed as a willing buyer.
So in terms of the vision for the business, what is your vision for Bloom Developments?
Yeah, at the moment, we're very focused on delivering and executing our current joint venture and business plans. So kind of briefly touched on it earlier, but we are in an incredibly fortunate position that we managed to secure some funds to go and effectively manage a property portfolio with. And, we're very lucky, to be in that position. But that doesn't give us track record. For us, what gives us track record is actually buying a site, getting your planning, if that's what you're doing, executing it, letting it, managing it, and creating value from it. And we're not at that stage yet. We're still at the infancy stage where we're midway through some of these business plans. We're trying to keep our head down right now. We're trying to basically deliver our track record, which will then put us in a stronger position as a business, to enable our future growth. So right now we've got that focus, albeit the long term, we want to be here as a credible investment and development manager with a key underpinning focus on sustainability. 5, 10, 15, 20 year kind of expansion plan is quite difficult to kind of put in place right now. It's quite difficult to know where we're going to move in terms of market, in terms of funding, in terms of maybe even asset class. at the moment, but as and when that evolves, we will be thinking, how we can best position ourselves for the long term. But at the moment, we are quite a small team in a small office, in a very fortunate position, but we need track record.
Working very hard by the sounds of it. So what's your vision for the business and future growth?
It's an interesting question, one that is constantly in the back of our minds, Sam and I's minds. At the moment, though, we are focused on delivering and executing our business plans in our current joint venture with Angelo Gordon. We're in a really fortunate position where we've managed to raise some funds. We've actually got a small office and a team, having been working in a kitchen around 18 months ago, but we're not getting ahead of ourselves. We need to get track record, and the way of getting track record for us is by actually executing our business plans rather than just deploying capital. So that's our kind of key short-term focus. Having said that, we've always got an eye on the future. We want to be here as a long-term, credible investment and development manager. We want to build on our current assets under management, if you want to call it that, and keep getting bigger and bigger effectively, and keep growing our business and our organization and team structure alongside that.
Amazing. So someone listening to this will be incredibly inspired by what you and Sam have done. What advice would you give someone who's sat in a similar position to you were at 26, 27, 28, who's got a desire to set up their own business? What advice would you give to someone?
I think my advice, if you're in a position or financially, or where you don't have as many responsibilities as you might do when you're married or when you have kids, etc., which was the position Sam and I were in. We're 28, no mortgage, no kids. We're in quite a fortunate position where there wasn't really, in my view, actually that much risk for us going out and setting up. I always thought if we went out and set up and for whatever reason it didn't work out, we would have met an incredible group of people along the way. We would have found out a lot about ourselves, what we're good at, what we're not good at, kind of a lot of exploration on who we are as well as find other opportunities along the way. So I didn't see there being that much risk with doing it, but that's because of the fortunate position I was in without all those responsibilities. But having said that, we just started our business 2 years ago. We're not seasoned entrepreneurs. I think there are definitely better people to take advice from. But if I was to share kind of any learnings, the one thing that I think was really important for us was, and also important for me, having probably looked at 4 or 5 other businesses before I started Bloom and trying to get them off the ground, is actually to try and really focus hard on what matters. It's so easy to waste time in the early stages focusing on building a financial model, looking at tax and legal structures, working out your organization chart, building a website. Ultimately, what you're thinking at the beginning is probably going to change anyway. So I feel what we've done quite well is just really focus on the customer. We've really validated the problem and we've worked out what needs building and how quickly we can build it and get to revenue. All the other parts need attention. Of course they do, but you've got to focus your limited resources on the stuff that's going to make a difference and make a difference quickly. And particularly when you don't have revenue, because the longer you are trying to get to revenue, I'm sure there's probably stats on this, but I imagine the more likely you are to either fail or give up. Otherwise, finding a great co-founder with complementary skill sets and different ways of making and thinking decisions between you has been really helpful. And I touched on it earlier, while Sam and I are both property people, we do have different experience and slightly different skills in both property and life. We also have, certain different characteristics, and we're really lucky that gives us, perspective when making decisions. Whether those decisions were the right ones or will be the right ones, I guess we'll see.
Time will tell. It sounds like you're tackling a problem that needs a solution, and Bloom Developments and your ultra-urban ethos is certainly addressing that. Just before we close, a question that I ask everyone is, if you're given £500 million worth of equity, who are the people, what property, and which place would you look to deploy that cash?
It's got to be Adam Newman, right? He doesn't need the money, he'll be fine. Again, I'm not by any means really qualified to answer this question, being purely a warehouse geek. In fact, I actually remember being asked this exact question by CBRE in a graduate interview and getting rejected shortly thereafter, which kind of proves my point. Having said this, I think there's a really exciting trend or opportunity at the moment, which is around the OpCo and PropCo business model, and which is effectively having an operational business that generates income from customers, but that very business that generates income also owns the real estate. And I think that's a very attractive position because you can benefit from the income generation, having control over that and oversight of that, as well as potentially creating capital value from that. The self-storage and builders merchant operators have been doing this for a long time.
McDonald's
before it even became fashionable. And I think at the moment there's a very exciting trend. There are very exciting trends where this model can potentially be replicated, either looking at e-commerce aggregation for small e-commerce businesses to try and basically fulfill their goods to the end consumer and do it quickly, or in the food delivery space, i.e. the dark kitchen space. And I think these trends are still kind of at their relative infancy. Jeff Bezos would get the lot, in my view. Not that he needs the money either, but he's a guy who has basically driven the huge innovation and instant delivery sector and logistics sector, or been a big driving force within that. And I back him and Amazon, to be honest, to drive the hyper-local fulfillment sector and food delivery market. I'm sure they're going to have their influence on that somehow.
Getting Jeff Bezos on your advisory board would be a decent scoop. And then in terms of place, would you be looking at building on what you're doing at the moment in central London?
Depends if I'm that involved in the business. If it's just Jeff Bezos, he can do it anyway. He can get the team in place. But no, I think, a big part of what we're doing as a business and what we're excited about is the real lack of supply of warehouse space in these more central locations in cities, not just in London, but, in other cities where there are similar kind of constraints around congestion and getting products into the city quickly. And I think that exists in other markets in the US, in other markets in Europe, like Paris or Barcelona. And I think, those markets, creating a global company with a global brand, doing exactly that, where also, unlike the UK, which has a very high e-commerce penetration percentage as a percentage of total retail, some of the European markets are far lower, so there's a lot more growth and potential value to be created there. So yeah, wouldn't want to just silo ourselves in London.
Amazing. Well, look, thank you so much for coming in and sharing your story. I look forward to watching what you and Sam do, and wish you both every success, make a huge impact on the ultra-urban warehouse space.
Thank you very much, Matt. It's been a pleasure speaking to you today, and likewise looking forward to seeing Rockbourne's evolution continue.
Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockbourne. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockbourne.com, where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.